It's Saturday night, and the feeling's right for a tech stock tier list. These are the stocks that happen to be on this list I found on TierMaker. They're listed, it looks like alphabetically, from Activision all the way to Tesla. So Activision is first on the list. So they are ranked from super amazing to stay away. The way I will be evaluating them is based on whether I think they are a good buy opportunity at today's prices. Okay? So with Activision, this is sort of an arbitrage situation, right? If you're buying Activision today, it's most likely on the hope that the Microsoft acquisition goes through at $95. Activision's current share price is around roughly $90. So, honestly, to me, at this point, it's a little bit meh. Now, if the share price was like 50 or 60 bucks and you were looking to make, 50+% on it, it would be a bit higher on the list here. But frankly, a mid-single-digit return and this is a maybe mid-single-digit return for an arbitrage thing, it just doesn't get me out of bed in the morning, so I'm not all that interested. Now, Adobe is next on the list. They are one of those software companies where their products are just everywhere, especially in the creative space, okay? They're most well known for Photoshop, which I think everybody would agree is one of the most well-known and well-regarded pieces of software pretty much anywhere in the world for what it does. And the issue I have, with Adobe, like with a lot of different software companies, is it trades at an extremely high premium. And, one must wonder what the growth prospects will be for Adobe. So, I'm sitting here thinking, okay, they're growing for sure, but what growth would they need to justify the multiple? They're buying back shares, but are those cheap or expensive shares they're buying back? That's the big question. Yeah, their PE and price to free cash flow are both quite high. So they're buying back expensive shares, and while they are growing, I don't think that's the best use of their capital. This is just one of those things where it's like, I think they're a great company, but the problem is they're not really at a particularly attractive price today. This is definitely a mid-tier opportunity. I think you could do worse than investing in a company like Adobe. Next on the list, we have Alibaba. And if I look at it, I think at this point in time, this is actually the only company on this list that I actually own. Now, Alibaba is growing rapidly. A recent slowdown, but I think that's pretty likely to be temporary. But even if not, they trade at a much more attractive multiple of both earnings and free cash flow. They are in one of the fastest growing economies in the world, with one of the fastest growing middle classes in the world, or if not the fastest growing middle class in the world. Now, there's risk associated, geopolitical, and all of that. But if we set that aside and think only about the financials, this is in the super amazing, or S tier, class. All right. Next up, we have Amazon. So, Amazon is printing the Bezos bucks in a lot of ways, but the issue is that the bottom line seems to always struggle to keep up. All right. Amazon has historically been a very unprofitable company. They've managed profitability in certain periods, don't get me wrong, but it always seems like they're always chasing that next growth stage and don't have that much focus on creating bottom line value for shareholders. So as big as they are, I just wonder, where is the future growth going to be? Like, when will they be big enough that they can then focus on the bottom line and actually returning value to shareholders? That's the big question. Alibaba is often considered to be the Amazon of China. So look at this growth from Amazon. They are already a $500 billion revenue company. I think at some point you have to factor in that growth will slow down. And negative net income, negative free cash flow. Yeah. I know that when they have that much revenue, just increasing their bottom line margins by a couple percent would translate into big profits, but they need to get on that and figure out how to make this attractive for shareholders. AWS, of course, is high margin and growing, but what about their retail? How are they going? I know that gets people into their ecosystem, but where's the money? Where's the money? It's the money, Lebowski. That's what I care about. So, with that, historically, even when they were profitable, the multiples were absolutely bananas. So, unfortunately, at the present point in time, I'm kind of avoiding Amazon. Now, if the price were to drop steeply, I think I might take a chance and pick some up, but currently, nah. Next up on the list is Apple. So, Apple, needless to say, is in just about everyone's pocket. Now, except for mine. I got Daddy Samsung over here in my pocket, but for everybody who's fashionable and cares about what people think about what they have in their pocket, it's Apple all the way. Warren Buffett loves Apple, okay? Everybody freaking loves Apple. And I don't blame them. I made a video about Apple recently. They pretty much defy all the rules for businesses of their size. Every time you think they can't possibly keep up the tremendous growth, they do. They keep going and going, and they return value to shareholders through both buybacks and dividends. Now, you could argue whether buying back shares in the 30-something PE range is accretive for shareholders, but they have so much cash that they honestly have a hard time sometimes figuring out what exactly to do with it, and that's one of them good problems. So even at current prices, Apple is potentially an amazing opportunity just because of the fact they seem to defy all the rules. Now, I'm personally waiting for it to get a bit cheaper. I'm a value investor. I need my entry point to make sense. I do think there's better values out there in the market right now, but in terms of tech stocks, they are pretty much one of the most dependable, stalwart companies that exists, and widely considered to be one of the safest places to put capital. So there you got it. That's Apple for you. Now, next up we have CrowdStrike. This is one of those fast-growing, in terms of revenue, but very unprofitable type companies. Honestly, I'm not really interested in companies that don't make money or don't seem like they're close to making money. Anybody is welcome to comment below if they think that's short-sighted, but yeah, I'm just not about paying through the nose for unprofitable, share-diluting companies that may or may not ever give us a return. So that's just my opinion there, so I'm staying away currently. Now, next up, we got Meta. Now, when they were at like $90 a share, they would have been in the S tier for me. I sold puts on both them and Baba when they were at lows. Only got assigned on Baba. Wish I would have gotten both, but it is what it is. At current prices, I think they're probably pretty... They may be like slightly above fair value, but when ads come back and everything, I think they're going to be gangbusters. They have more eyeballs on their platforms than almost any other, except for a couple on this list, companies in the world. They've got, as far as social media goes, they've got Facebook and Instagram. They also own WhatsApp. All have many, many users. They've got billions of people using their platforms, and they sell ads and they sell data, and information and data are gold. Eyeballs are gold. It's just the valuation, right now, it's nothing to write home about. It's mid-tier, though. It's a pretty good opportunity still. Next up on the list, we got the GOOG. So Google owns the top two search engines in the world. That is Google.com and YouTube.com. Yes, that's right. The search feature on YouTube is the second most used search engine on the entire internet, second only to Google.com. Both are owned by this company. If you watched any ads on this very video, you have actually made money for Google. Not me, because I don't get ad share yet until I get to 1,000 subscribers. But you can hit the join button. You're welcome to do that if you want the money, some of it anyway, to come to me. Preferences and all that. Now with Google, they've got the different classes of stock, but they pretty much trade in tandem. So Google, honestly, they trade a bit of a premium, but I think it's justified considering what an amazing company they are. And they have, I guess, what you would call monopolistic features. Now, their growth isn't like, I don't think it's going to be 50% a year or anything, but I do think that they are going to continue to grow revenue. And I think that they continue to be a very, very high quality business. And again, they own how much of the internet is actually owned by Google. It's freaky to think about. And again, talk about people who have our data. Eyeballs are gold, our clicks are gold, and our data is gold. Google's got all of that in spades. So, honestly, Google, even at the current slightly premium valuation, I would say is an amazing opportunity. In fact, maybe even a little bit better than Apple. So that's just my take there. Next on the list is IBM. Now, IBM is kind of like the dinosaur on this list. Okay, they've been around for like 80 years or something. They've been around forever. They were selling machines during like World War II. Okay, so they've been around a while. Honestly, I think they've seen their better days, even though they do pay out a dividend and like some stuff like that. I don't know what it is that they're going to be able to do to revisit their glory days. This is really just meh for me. It may not necessarily be a stay away. It could be a turnaround play, potentially, something like that. But it's really, I'm just always underwhelmed whenever I look at IBM, to be honest with you. Now, next up on the list we have Microsoft. Talk about high quality businesses. I mean, Microsoft is in almost every major corporation, at least in the United States, if not the world. At work, I use Outlook, I use Excel, I use Word, and frankly, they're just ubiquitous, right? This very laptop I'm on right now, Windows, Windows 10 or something like that. So they're like, who has a computer at home other than, if you're not on, some kind of Apple, iMac or MacBook or whatever, pretty much everyone else is on Microsoft. I mean, there might be some people using Chromebooks or something, but I mean, Microsoft's the big mamma jamma. And again, they have those monthly fees for their software. They've really switched over to, if you want to have the Microsoft suite, it's okay. It's a few bucks a month, and you get all the updates and everything like that. And every big, corporation, pays per user for those big enterprise accounts. And that's just straight money for Microsoft. Not to mention they have a lot of the gaming industry. They own Xbox, for example. Trying to buy another company on this list, Activision. Microsoft has a lot of things going for it. I think they're an extremely high quality business. Now, the only thing is the valuation is pretty high, and typically when you make acquisitions, it tends to be a little bit high on the price, and those can kind of inflate. They aren't usually buying bargain basement opportunities when they make acquisitions, right? So, are those really great for the shareholders? There's an argument to be made that overpaying for an acquisition isn't. So, even still, I think even at current prices, this is a pretty reasonably good opportunity right now, and I wouldn't hold it against anyone for having some shares of Microsoft. Next up is Netflix. So Netflix has been ticking a lot of people off lately with the thing of not letting you log in anywhere except from home. That kind of makes me angry because I like to travel, and I mean, they were like, oh, well, you can for up to a week at a time or whatever. And it's like, I like to travel for more than just a week sometimes. And if I'm in my room at night trying to chill, I want to be able to, use the service that I pay for. And part of the value of streaming services is you can access them anywhere. You don't have to haul your DVD collection with you, right? In your suitcase, essentially. So they're kind of, I don't know how I feel about, I think that's possibly going to make it so that people cut down on the sharing and whatever, but is getting rid of the sharing worth alienating your customers and making people cancel your service potentially if it backfires? That's a concern. Now, they do so much revenue growth. It's kind of crazy because I would have thought, even as of 2020, 2021, everybody who wanted Netflix probably had it. But the fact that they've continued to grow just shows that there are more opportunities. I think especially internationally, that's probably where they're getting most of their growth. Now, that being said, they're at kind of a high multiple. I view them as a bit overpriced, honestly. If they were in the 20s somewhere, I could see it, just because they're a high margin business and they can always inch up those subscription fees ever so slightly to keep the bottom line growing. I don't know. This kind of underwhelms me, honestly, at current valuations. I wouldn't necessarily throw stones, but like it's meh with a borderline stay away actually right now. Next up, we got PayPal. So PayPal is one of the most popular payment processing companies in existence. They have their namesake, PayPal, which is used in many different places in the world. They also have one of the most popular peer-to-peer payment apps for the phone, Venmo, which I love, and I think everybody I know loves Venmo. And frankly, I don't see PayPal going away anytime soon. They have a lot of super convenient ways for people to, pay money to each other, as well as, valuable features for merchants who want to, sell things online and such. They offer a lot of different protections for their users, a lot of security. I've heard some negative stories about like whose side they take if there's a dispute or something, but it's better that there's somebody there at least, creating some accountability in those transactions and acting as like an intermediary in a lot of ways. So PayPal provides a pretty valuable service, and honestly, lately the multiple, their price has plummeted recently, right? Market cap down like 80% from their highs, but their PE is still pretty premium, although their free cash flow is seems like it's a lot higher than their earnings, which is you do want to understand why the difference, but this is a much lower multiple than a lot of the other companies on this list. And, they're still showing very consistent growth. Now, again, like a lot of other companies, a slowdown in 2022. And when 2023 numbers come in, maybe they won't be so great either on an annual basis. But overall, I think this is a company where it may be hard to see it at levels this cheap again in the long run if it has a recovery as they continue to grow. Now, they've also done, a few little buybacks lately, nothing too substantial, but, I think if they, fire up that buyback program, and, keep doing that whenever they're at a fairly reasonable multiple into the future, you could have a real interesting compounding effect with this company. Now, one worry I have with it is I was seeing that like FedNow was potentially going to have ways for people to send money to each other, but I'm not sure exactly what that's all going to entail and what the details will be of that. But frankly, I still don't think PayPal's going anywhere, and the current multiple being what it is, I mean, honestly, maybe it's not as good an opportunity as Baba, but it's a pretty great opportunity. Now, this Q, I believe, is Qualcomm. Qualcomm is one of those companies that kind of operates in the background, doing semiconductors, building out different technology for mobile networks and that kind of thing. So they kind of operate sort of in the background. You don't really see them up front and center. You look at different branded products you have in your house, you don't really see like Qualcomm plastered on much in the terms of like consumer products, but they do have a presence in your everyday life, right? If you use a mobile phone, there's probably some kind of technology involved on like the cell towers or whatever, somewhere in the line that has to do with Qualcomm. Okay? It creates semiconductors, software, and services related to wireless technology. It owns patents critical to 5G, 4G, etc. So, yeah, this company is a pretty big deal, okay? And if you notice, they trade at a pretty reasonable multiple of both earnings and cash flow. Okay. Now, granted, this is not going to be the supercharged growth that you're going to have in some of these other like pure software plays, but I do think that in the long run, wireless, semiconductors, 4G, all 5G, especially 5G, which is still kind of a growing thing, is going to be a pretty big deal. And I think Qualcomm has some room to expand the business, and if they stay at these low multiples but their revenue and their earnings, etc., stay up and growing, I would love to see them continue to aggressively buy back shares, which they have done. So Qualcomm is amazing, borderline super amazing. I really like them as an opportunity. In fact, they're now they weren't really on my radar so much before making this list, but the more I look at them, the more I'm kind of talking myself into maybe wanting to do something with Qualcomm. It looks pretty good. Just need to maybe take a look at a 10K and educate myself a little more. Next up, we got Shopify. Okay, so it's an e-commerce type deal. Doesn't make money. And anything that doesn't make money, it's in the stay away category. All right. It's one of those things. Like, it's not really showing what its actual return potential could be. And, the market opportunity could be tremendous. There could be a lot of growth, and it could be that one day they grow enough to be profitable, but it's pure speculation at this point. Most of the other companies on this list have proven that they can turn a profit. So they obviously will be a little higher on the list, right? So Tesla is the last one. Now, I would even argue Tesla being a tech stock, but I guess, because their battery technology and some of the components in their cars are pretty new, and they're a very innovative business in a lot of ways, you could consider them like an automotive / tech hybrid, I guess. Hybrid auto, get it? So what do we think about Tesla? So I don't think they're a bad business by any means, but you have to look at these multiples, okay? Because what they ultimately sell are automobiles, all right? Even if the technology in the automobiles is innovative, there's going to be limitations when it comes to the margins, okay? Now, the revenue growth also, yes, tremendous, right? But the growth train will have to come to an end at some point. Now, as you all know, I avoid this because I think its ratios have been bubble territory for a while. They dilute, so even though their net income is growing, you're getting a smaller and smaller piece of it as they issue shares onto the market. Now, that does help them avoid taking on debt, but the dilution is an issue, okay? Because I think a lot of people aren't factoring that. They just think the growth is coming for free, and they don't realize that their shares represent a smaller and smaller slice of the business as time goes on. And frankly, I think with some of the price cuts and such that have been happening with Tesla this year, I'm worried about what that's going to do to these gross margins. The gross margins have been excellent for a car company, but once they slash the prices, and when we see 2023 data, it's going to get real ugly if this gross margin goes from like 25% to like 12%. Okay, beware of that. So with that stuff in mind, they have proven they can make a profit, but still it's a meh for me, man. Like, I think that the mid-tier companies have much better gross margins that are going to stay pretty consistently high, and they don't need as much like capex and whatnot as what Tesla does to build all those factories. They don't dilute, etc. But they do turn a profit, and they do have a lot of growth. So they aren't in the stay away category. I think I would buy them for the right price. I mean, I guess I'd buy Amazon for the right price too, but it's hard to determine what the right price is when they aren't barely turning a profit with $500 billion in revenue. Tesla at least turns a profit, and if it fell in half, I would be starting to look at it a little more closely. So that is the tier list. Okay, 2 of these technology companies are in the super amazing. 3 are in the stay away category, and the majority are somewhere in between. Let me know in the comments below what you think of the tier list. What do you think are the super amazing S tier companies? What do you think are the stay away companies? Do you have any of these companies in your portfolio? Let me know what your cost basis was. Take it easy, ladies and gentlemen, and don't forget, join the Discord. Hit the join button to be a member. And I'll be streaming tomorrow, 9 p.m. Eastern. I'll be having Ryan as a guest on the channel. Take it easy. Bye-bye.